Good afternoon. My name is Ala McCoy. I am Director of Startup Support at the University of Maryland Ventures. I would like to extend a warm welcome to all of you who joined us today for the next installment in Startup Fundamentals Workshop Series, both live webinar audience and those who are watching a recorded version on our Startup UMD YouTube channel. This workshop series is offered by Ventures, MTech at the Clark School of Engineering, and Dingman Lamone Center at the Smith School of Business. To everyone attending the live session, please feel free to submit questions using the Q&A function at the bottom of your screen, or you can also just put them in the chat. Our presenters will monitor the questions and will stop somewhere halfway through the presentation to address any questions that will have been there. And also, if you see a question that you'll like, you can upvote it in the Q&A portion. So we're recording the session. It will be posted on our Startup UMD YouTube channel. So in the Q&A function, you can submit your questions anonymously. In the chat, you can't. So if you'd like to remain anonymous, use the Q&A function and click anonymous. So today, I'm very pleased to welcome Jordan Chislom and Eli Wolfe. They're both attorneys with Cozen O'Connor. Jordan focuses his practice on business and corporate matters. His practice spans mergers and acquisitions, emerging businesses and venture capital, entity formation, financing, joint ventures, and general corporate matters. Eli's practice focuses primarily on mergers and acquisitions and emerging business venture capital transactions, from formation to exit. He also advises public and private companies in a wide variety of industries on various corporate matters. So today's webinar, Startup Equity, what it is and how to divide it from Series Seed and beyond, will cover the essentials of equity for early stage founders, from choosing the right type of equity to dividing equity among co-founders, early hires, and advisors, a very important topic. So thank you so much, Eli and Jordan. I am going to turn off my camera, turn off my mic, and the stage is yours. Thank you so much for spending your time with us today.
Thank you, Ala. Thank you so much, everyone, for joining us today and tuning in to what we consider a riveting topic, and hopefully we can get you as excited as we are to talk about emerging companies and really the equity question, which is one of the most important ones. So Ala's already given you a great kind of overview of myself and my partner, Eli. So I won't say the same thing. And I'll tell you a little bit about who we are as a firm and why we're talking to you today. So our firm's called Cozen O'Connor. We are a international firm. We have about 925 attorneys across 30 offices in the US and Canada. We're in pretty much every market. And as a Philadelphia headquartered firm, we're particularly active in the mid-Atlantic. So New York all the way down to Washington, D.C. I reside in a Miami office, so not the Mid-Atlantic, but it kind of just demonstrates how cross-office we are, cross-functional. We have attorneys in every practice area, from Eli and myself, who primarily practice corporate law and all the things that Ala mentioned, to intellectual property. We have folks as far as the Midwest. A number of the participants are from our Colorado offices, who exclusively focus on IP and particularly tech transfer licensing with universities. So that just gives us an edge and an ability to be so full service when we are working with emerging companies who need a lot of support. And then, of course, as a law firm, we litigate as well. So it's just kind of a natural part of our practice. This just gives you, and I'll stop boring you with who we are here, a sense of how distributed we are. I think even since this was published, we might have had another office. So we're always expanding our presence and trying to get enmeshed in markets across the US. So if there's a local issue or a federal or any international issue, we can probably help. So today, we're here to talk about startup equity, and I'm going to turn it over to my partner, Eli, who's going to start not in equity, but with the topic of what type of entity are you? So Eli, I'm going to go ahead and take it away.
Great. Thanks, Jordan. Appreciate the introduction. Welcome, everybody. Good afternoon. Really appreciate you guys taking the time to be with us today. I will start with also the broad disclaimer that we're required to provide as a law firm, that this presentation does not constitute legal advice. in order for us to have an attorney-client relationship. And for this constitute legal advice, we'd have to be engaged by any one of you. So we're really, providing this webinar as an informational overview. To the extent that any of you have follow-up questions, we'd love to work with you in the future, and you'll have mine and Jordan's contact information. But with that, I think that this first slide is just a great kicking off point for this presentation, and really for any emerging business, whatever stage you are in. Really, the initial question for any startup is, what type of business entity am I going to be? And so you'll see we have this list, and when we get to the next slide, you'll also see limited partnerships and limited liability companies on here. But I think what I want everybody to focus on here is that top kind of navy blue line where it says entity type, ownership and governance, liability protection, and tax treatment. Those three categories, sort of ownership and governance, liability protection, and tax treatment, are the three main issues that any of you are going to look at and give thought to in order to best determine what type of entity do I want to be at initial formation, right? Many of you may not be there yet. You may have an idea, a concept, some type of intellectual property that you've developed as an individual or in connection with UMD. But to take that idea to the next level, monetize it, grow it, at some point you're going to need to form a legal entity. So on the left side, you'll see some standard types of legal entities. The first is a sole proprietorship at a very high level. This is basically where an individual operates a business. I do not think that any of you will probably fall into this bucket, but we would be remiss if we didn't, discuss it very briefly as one of the types of entities. The next, you'll see a general partnership where each of the partners, basically has equal governing rights. They can bind the business. There's unlimited liability. Each of the partners is basically liable for the debts and obligations of the entity. And as with a sole proprietorship, an S corporation, and certain limited liability companies and limited partnerships, it's generally flow through taxation. And that means that tax treatment flows through to the ultimate owners as opposed to being taxed at the entity level. As Jordan has so helpfully highlighted in green, the most typical entity that you will see and give consideration to when you're thinking about forming is a standard C corporation. You've probably heard this before, but when it comes to corporations, they're traditionally governed by a board of directors, one or more directors. We think it's best practice to have a board and always to have an uneven number of directors so that you don't find yourself in difficult deadlock type positions. The board of governors effectively have, oversight over the company, but appoint officers to run the day-to-day. So you will typically hear of, a C-suite level of officers at any given entity, a CEO, a CFO. In this case, maybe a CIO, Chief Information Officer. You might have an intellectual property officer, but it's governed by a board of directors and then run day-to-day by officers. The advantages of a corporation are that there is limited liability, and in particular for the shareholders. Folks owning an equity stake in a C corporation are not liable for the obligations of the entity. One of the important aspects of a C corporation, unlike some of the other entities that we've talked about, are that there is what we call double taxation, or it is taxed twice. The corporation itself is subject to tax treatment, files its own tax returns, and then the shareholders, to the extent they receive distributions or dividends, or certainly in any sort of, either liquidation or change of control transaction, would receive proceeds that would also be subject to taxation. The next entity type sorry, go ahead, Jordan.
Yeah, so just before Eli moves on from corporations, one of the things that may be kind of lingering in everyone's mind is, okay, so I understand for the purposes of governance that there are these different groups of people, But can those people be the same people? And the answer is yes. And I always like to explain this to clients in terms of hats, right? Like which hat are you wearing in when you are doing something for the corporation, right? As Eli said, the board of directors is the ultimate governing authority who is written in the law responsible for managing the affairs of the corporation. So me and Eli could be directors wearing our director hat and thinking about what's in the best interest of the corporation. What's in the best interest of the corporation may not be in the best interest of me personally if I am a shareholder. So in my shareholder hat, we may be thinking about making an investment that making a capital expenditure, doing something that makes my investment a lot riskier. But you know what? That's what's in the best interest of the corporation. So as a board member, it's my fiduciary responsibility to make sure I do always what's in the best interest of the corporation, because that hat is one of the most important hats to wear. And what's also best for the corporation, if I am also the CEO, may not be in my personal best interest. You may need to fire me, right? Because I'm not the right person to actually oversee the company. But you know what? If I am also a director, my director hat trumps. And it's more important for me to do what is in the best interest of the corporation, even as an officer. It may be more sensible to fire me as the CEO, but retain my board seat and my influence over the company. So just I can wear multiple hats as a director, as a shareholder, and an officer, and it can be the same person.
That's a great point, Jordan. And something for everyone on here to think about is, you know, the risk associated with wearing multiple hats is mitigated early on, right? If there's two joint founders who are both acting as directors and both acting as officers, they have to ultimately answer to themselves as the two shareholders. And you'll see this when we get to the cap table later, a very early stage cap table. Where things start to get trickier, and we will also hit on that later in this presentation, is as you start to take on investors and you have multiple stakeholders, right? Of which you are still one. You're still a shareholder, but now you have other third parties that have invested in the company. Wearing those multiple hats just becomes a little bit trickier. You have to think about what your obligations are with respect to any given decision you're making. The next entity type we had up here, still a corporation, but what we call an S corporation, a corporation that is treated for tax purposes as a flow-through entity, such that the ultimate owners, are taxed as opposed to the corporation. Now, there are certain specific restrictions with S corporations. You can only have a maximum of 100 shareholders. They are limited to U.S. citizens, and furthermore, there's certain limitations on the types of entities that can also be shareholders. We're not going to delve into all of those different types at the moment, but something to be aware of, because Jordan and I have both faced situations as counsel where somebody has elected to be treated as an S corporation, and we've subsequently found out that a shareholder is one that effectively, you may hear this term, has blown the S election, right? Has made it such that the corporation can no longer be treated as an S corporation. I think we can move on to the next one, Jordan. Two other entity types that you will hear a lot. One is probably going to be more applicable than the other is limited partnerships, whereby you have a group of limited partnerships or limited partners and a general partner that controls the day-to-day, in effect, can act like a board or a manager of an LLC, has fiduciary duties to the limited partners. Those general partners have unlimited liability. They are on the hook for all of the obligations of the partnerships. The limited partners, hence the name limited partner, have limited liability. Similarly, as discussed, generally treated as a flow-through entity for tax purposes, and distributions are generally tax-free. You will hear us use the word tax a lot. We strongly recommend, when thinking about entity types or any decisions that will impact tax treatment, to seek tax counsel, whether that's a tax attorney or your individual CPA. The last entity type that you probably all are somewhat familiar with and maybe have even formed some of these are limited liability companies. So limited liability companies try to give the best of all of the different entity types, right? They are by default treated as flow-through tax entities. They are flexible from a governance perspective. So a limited liability company in its operating agreement can actually deviate from what is dictated by statute, unlike a corporation. They can be managed by the members, or you can set up a managerial structure that operates similar to a board of directors. Um, and what's most important about a limited liability company is drafting, a thorough operating agreement, an agreement that is the agreement of the members with respect to how the entity, will operate. Everything from day-to-day decision making to fiduciary duty, transfers of interests, and the like. I think that's a pretty good overview of entity types, so we can get into the meat of this and what you're all here for, which is different types of startup equity.
Awesome. Thanks, Eli. So we've given you kind of a really generalized view of the different entities and ultimately what you would own as either a founder or even an investor is equity in the entities, right? And we're using that term kind of loosely, but it helps to define it, right? So what is equity capital? Equity capital is just financing, right? It's financing and units of ownership on an ongoing business entity. Doesn't necessarily need to be an operating business. It could be a holding company, but it is those things that you own that evidence that, hey, I actually own an interest in this ongoing company. Equity, whether it's stock, LLC membership interest, or limited partnership interest in a limited partnership, is a security. Right. It is something that represents an interest in an ongoing enterprise. And as we'll discuss later, the purchase and sale and issuance of equity is subject to the federal and state securities laws. There's not any way to get around it, right? So when you buy a stock in a corporation, you are entering into a securities transaction, right? And depending on, how the transaction is structured and what the quality of the company or what the structure of the company is, it may or may not be governed by additional requirements that you have to comply with. So the basic way that people or entities acquire equity is as you would think, right? I pay cash, I get equity, whether that's stock, LLC interest, etc. And that basic transaction is a market transaction, right? Almost all equity kind of exchanges are private transactions between the buyer and the seller of the entity. So we would call that I've given you cash and I got a share of stock or I've gotten an LLC interest, and the price that I pay for it, a market price, right? Now, in general, when you first form an entity, there is no market for the entity. There's almost like nothing there. And so, in many instances, the founders of a corporation or an LLC will and should pay for their equity because equity should have some type of unit of exchange, but it won't be a market price that you would traditionally think. It's usually going to be a nominal price. In some cases, if the corporation, for example, has a par value that's set out in its governing documents, the price per unit of equity will be the par value. And usually it's fractions of a cent. If you look at even publicly traded corporations to this day, their par value of their equity is fractions, hundreds, or sometimes millions of a cent, right? And so when you first form the company, there's almost nothing there, there's nothing in the company. And so that's why it makes sense to price the value of your equity at a nominal or par value. And sometimes there will be an actual exchange. Sometimes it's like $20 that you're paying to get millions of shares. Why? Because the value that you're paying is very, very low. But that's not the only thing that you can use to purchase equity. You can also contribute, meaning transfer something that is yours into the entity to make that asset that you have the property of the company instead of yourself. You can contribute property, and you can even contribute intellectual property, particularly for technology companies and life sciences companies. The IP is everything, right? Whether it's the code, whether it is a patent, whether it's just kind of know-how that governs like how a certain business is pursued. Those things collectively are intellectual property. I mean, you can't touch them, but they exist, right? And there's other kind of legal frameworks that would give heft to those forms of intellectual property. But a founder can transfer intellectual property and other property, equipment, etc., into the company, thus making that the property of the company. That's going to be very important, particularly when you're raising capital from third-party investors. They want to make sure that you, as the founder, are not holding on to a critical piece of intellectual property or technology that the company relies on to pursue its business, right? So a founder can contribute intellectual property to pay for its shares. Then you often see it as a mixture of both, right? But the point is, everything that was once mine as a founder that went into developing this company, right? I'm not necessarily going to form the company day one. I may form it after I figure that I have an actual product or traction. I need to put it into the company's name. Okay, so the last thing on this slide that we wanted everyone to understand is that, if you follow business, reporting, business literature, most of it is about the sexy stuff, right? Publicly traded companies, and we're talking about equities markets in which the equity of companies that are held by a diverse set of shareholders who have followed additional securities requirements, those are traded freely. So that's a liquid market, right? Like if you have a share of stock of Apple, you can trade it and have high confidence that the price that you want is going to be the price that somebody says they'll pay you, right? Most companies in the United States, though, just from a sheer volume and number, are not publicly traded companies. And so this chart here from the S&P's Capital IQ product shows that, right? From 87% of US companies with more than $100 million of revenue are privately held companies, meaning not publicly traded, not without a diverse shareholder base. And these are all the types of companies that you all are forming, right? So this just gives it helps level set us to really understand that most of the enterprise value for, US and even non-US, because you don't have to be a US company to be traded on US exchanges, is not publicly traded, right? And until the point that you actually have an opportunity to either go public or sell your company, your investment and your ownership is going to be illiquid. It's going to be hard to turn it into cash, right? And so, even though you have equity and it has a value, theoretical value, it's not something that you can just turn around and convert to cash. So hopefully this kind of helps you ground you and help you understand that you are like every other company, or the majority of other companies in the United States. You can't actually sell the shares of your company in a public, freely traded transaction.
Jordan, I had one thing I wanted to add real quick in the sale and issuance conversation, because it's a term I think a lot of you have heard or will hear. And it just piggybacks on what Jordan was saying about, you don't necessarily have to pay cash. You could contribute something of value. That doesn't have to be just something tangible or intangible intellectual property. You've probably heard the term sweat equity, right? The idea that you have given something of value, and that can even just be time and effort, right? I have worked X number of hours and my time is worth a certain amount. So that's just another way that somebody could effectively have paid without actually handing over cash or a tangible item of property for equity. So just when you hear that term, that's what it means. And I'm sure you will hear it, plenty as folks are asking for equity in your companies.
All right, so this is an important slide, and we'll tell you now, we are going to pause kind of after we've gotten through the content on this slide to give everyone an opportunity to ask questions. As things arise, there's a Q&A function in the presentation. Feel free to use it, and we'll try to just catch those questions and address them after. But we want to pause here because this is the whole ball game right here, right? Like you want to understand, if I found a corporate, and we're going to focus on corporations here, but the concepts are flexible to other entity types. But really, for emerging companies, it's almost always going to be about corporations, as Eli said earlier. So exactly what do I own, and what are investors getting when they give me money, and when they give my company money more specifically, and what am I giving them, right? So the first and most important class of equity is common equity, right? We would in the legal realm call common stockholders the residual stockholders, meaning after all is said and done, if the corporation were to stop its operations, liquidate all of its assets, pay out all of its creditors. And creditors is not just somebody who gave the corporation money, but also somebody who gave the corporation services, like, a software developer, or somebody who gave the corporation products, that it maybe sells later for inventory. Those are all different forms of creditors, and you can't just not pay them. Right. So those are kind of different forms of liability that need to be accounted for. But after all is said and done, the corporation's common stockholders are going to be the people who own everything that's left. So just do some back of the napkin math. If the corporation has, $100,000 of obligations, but there are assets, including, IP, cash, etc., that are worth $1 million, well, then that $900,000, assuming everything else is just in that $100,000, is owned by those common stockholders, right? So where companies go public and they find themselves with a wealth of demand for their shares, right? There is tremendous amount of excess value that ultimately belongs to the common stockholders, right? And so that's why common equity is something that people you should closely guard, because once you give somebody common equity, they get a piece of the leftover pie that hopefully, if you've got a good business, all the other common stockholders are entitled to. So founders always, in most cases, get common stock. In many cases where you have people who are service providers, whether they're independent contractors or consultants, they'll get common stock as well, but they'll get a special treatment. That's the equity incentive kind of portion of this. But just to stay focused, common stock, residual, everything after everything is all said and done. Now, preferred stock is usually reserved for financial investors, right? People who are giving additional capital to fund the corporation's growth, to fund its business plan. Sometimes it's as simple as funding inventory if you've got an asset heavy business. Sometimes it's to fund capex. Doesn't really matter what it's for. What matters is that what is the expectation of these investors when they are investing their money? Now, preferred stock is different than common stock. Well, it's similar to common stock in one important respect. Preferred stock is almost always convertible into common stock. So when you're thinking about the cap table as a whole, you should think of your preferred stockholders and your investors not just as financial investors, but also ultimately, after you pay them back, they'll be just like you. They'll be common stockholders as well. But it's the additional protections that preferred stock has that distinguishes preferred stockholders from common stockholders. And the most important protections are usually preferred stockholders will get first priority claim on the return of capital, right? So let's say you raise $100,000 from investors. If there is a big liquidation event or before a dime is really distributed to the common stockholders, the preferred stockholders will have a priority claim on that money. So it's really a return of capital mechanism meant to say, hey, you took the risk of giving us additional capital, and you did so at a valuation that was favorable to obviously mutually agreeable, but more favorable than the value that we paid as founders when we founded the company. You're going to get your money back first, right? So that's the liquidation preference aspect of preferred stock. Sometimes, and it's not in all cases, but preferred stock will have additional rights meant to disincentivize the company from doing things that dilute the value of the preferred shares. Why? Because they are preferenced, right? They have special treatment. So you'll see in governing documents a lot about anti-dilution. That's just meant to disincentivize the company from issuing shares writ large, right? From issuing shares of no value, because that completely destroys the value of this investment that preferred investors have made. In some cases, the preferred stockholders will have board appointment rights, right? Specific rights to say there is a board of directors of this company, and instead of everybody voting as a collective, because usually preferred stockholders don't take control of the company, they take a minority position. If we did it on a just everybody voting as a whole, the preferreds would lose, right? Because they don't own enough. But we're going to negotiate a specific right for the preferred stockholders to appoint a director, thus giving them not just ownership, but a say in the ongoing operation of the business. Now, where you have institutional investors, you'll see this a lot, right? They'll want to get a board seat and they'll want to keep a board seat until maybe an additional round of capital is raised by the company. You have another set of institutional investors. And some of the other rights that you'll see in preferred stock, preemptive rights, which are if you're going to raise more money in the future, I want to be able to participate so that I don't drop below a certain ownership stake, right? It's typical for institutional investors to want to not just fund the company the first time, but to participate each time the company needs to raise money as it reaches its milestones. So,
Jordan, one thing I wanted to add on the preferred is you will often preferred investors don't all bring the same thing to the table, right? You're going to have pure kind of financial investor preferred holders, right? I am cutting you a big check, $1 million, $10 million. And they, at the end of the day, are really trying to protect that value. That's the most important thing to them. You're also, I would say, sort of on the other end of the spectrum, you could call it, are going to have preferred investors that are more strategic for your business, right? I want to give this person some sort of preferential treatment because they're going to help me build connections. They're a thought leader in this space, right? Or they can help raise additional capital in the future. They can help get my product to market because they're an expert in this area. And so while we won't get into examples of, what you might give in each situation, those are things to think through, right? The pure financial investor at the end of the day is just trying to protect their investment and at the end really grow it, right? Whereas the strategic is probably going to be a little bit more involved in your day to day, right? They might be coming on as a true partner, not quite a founder, right? Because they weren't there from the get-go, but they're going to be, maybe a thought leader in this area. And so some of the things that you might not be willing to give a true financial investor and vice versa, you may be willing to give to one of these more strategic preferred investors. So you will very likely see that, especially for companies of this nature. You're going to have you're going to have a venture capital investor want to come in and simply cut you a check. They likely will want a board seat and some rights, but they're going to be pretty hands-off day to day. Whereas you might have a strategic angel investor willing to write you the same size check, $1 million, $5 million, but they want to be treated sort of as a new partner in this business, right? They're going to be integrally involved and they're going to want to be involved in decision making, not only at the board level, but maybe in that day to day as well. So just wanted to add in that distinction as well, Jordan.
No, Eli's exactly right. And what he's just said points to what is almost always the case, which is that when somebody's considering an investment in the company, it's highly negotiated. We're not just relying on the terms of the corporate statutes in whatever state your company is formed. You will adopt extensively negotiated agreements with your investors, right? Where you say down to the veto right, down to the value of each share of stock, exactly what they are getting. Where you are making agreements that kind of reside outside the defaults in the law, but they say, hey, for this company, this person is going to have a board seat, and this is how the board seat will be administered. Here's what you're not going to do without a vote of the board, and that has to include the vote of this person. It's extensively negotiated. Because I want to leave some time for questions. I'll just cover equity incentive shares to say briefly that this is a form of the sweat equity that Eli was talking about earlier, where somebody is not giving cash or property, but they are giving their labor, their time in exchange for shares. Doesn't necessarily need to be an employee. It could be an advisor, somebody who's giving you strategic advice, or it could be somebody who's going to work in the business, but because you're an early stage company and you don't necessarily have a bunch of revenue that you can cut them checks out of, you need to give them something, right? And so you'll give that person equity that is kind of limited by a plan. again, another document that you'll internally adopt. Equity incentive is different than people who financially invest in that there's different tax consequences. In some cases, in most cases, when the person receives equity incentive shares, they're not taxed on that because they're getting something in exchange for services, right? But there's some limitations on how many, the value of what you can give them, and how that's taxed over time. So again, this is where we recommend you kind of have a follow-up and work with your advisors. And the last thing we'll say about equity incentive equity incentive shares is that you can often have vesting restrictions. Instead of giving somebody a full 5% in your company up front before you've known if they've established value, you can parse it out over time so they don't have the full 5%, but they'll get it over, 3 or 4 years.
And a
Um,
good way to think of that, I think, is looking backwards and looking forwards. Are you bringing on somebody who you expect to contribute to the future value of the company over the next year or two? Well, certainly you're not going to want to give them all of those shares up front and risk that they leave 6 months later, right? And now all of a sudden they have a material equity piece of your company and are no longer providing the value that they had initially promised. There are also instances where somebody, and especially in the early stage phases, where they have contributed a lot of time and effort already. So you may be issuing these shares for those past services rendered, in which case it's maybe less likely that they would be subject to these same restrictions. But to both the point I made earlier and to Jordan's ultimate point, as you are preparing to create what we call an equity incentive plan, or the other term you will hear, most often is option pool. That is a perfect time to engage an attorney to determine what it is you want to issue and to whom, and what the guardrails around that should be.
all right. Okay, so I'm going to turn it over to Eli to kind of take us from that theoretical concept to like what a cap table that your company could look like. All of this is theoretical. These are completely made up numbers, but this is a pretty emblematic example of what a cap table for an early stage company could look like.
So Jordan, I'm going to pause. We did get a question
Oh
in the
yeah.
webinar chat. I'll read it out for folks who may be on their phone or otherwise, and appreciate it. This is a great question. In our view, which financing instrument is generally better and more advisable for early stage fundraising? A SAFE, which stands for a simple agreement for future equity, or a convertible note? They would appreciate our perspective on the advantages and considerations of each. Great question, one we get very often. I'll give you the classic lawyer answer. It depends, right? Unfortunately. And I know that's not the greatest answer you want to hear. The way I think about these, and Jordan, to absolutely chime in if you feel differently. Again, I will go back to that caveat that this is my and Jordan's opinion of what we've seen over the course of our careers. This is not Cozen O'Connor's kind of view on any of these. And again, it's going to be very situational. A safe really allows you to take in money and, in my opinion, kick the can down the road of what am I actually giving these people, these investors, what kind of rights are they going to have? Frankly, I don't even know what type of equity they're going to get. They're going to get a piece of equity in whatever that future priced round that I do is. It will likely be preferred, but I have no idea what the terms of that preferred is going to be, nor do I even want to give thought to it, right? I'm at a stage in my company where I simply need capital to, file a patent, right? Or bring on a developer, or I need working capital, and I just don't know what the terms of that are going to be. The simple agreement for future equity has really changed the financing landscape since its introduction, since really Y Combinator pioneered it. What we have seen is it's what we'll call analogous type of equity, and what predates the safe is the convertible note. The convertible note was kind of the standard early stage financing vehicle prior to the safe. The issue, well, it similarly provides great flexibility, right? You are effectively getting capital for an agreement to, in the future, provide them with equity. That note, however, is a true debt instrument, right? It is going to stand on your cap table until it has converted as debt. So going back to what Jordan had talked about, with respect to, whether it's hopefully a banner liquidation, right? Where the company says for millions of dollars and you have to pay off your creditors first, or in a, you know, a true dissolution situation where the company didn't pan out and you have to pay off those creditors first. These notes are one of those creditors, while a safe at that time is not. So safes provide you with a lot of flexibility. I personally think from a company perspective, there probably are more advantages to the safe than the convertible note. However, as an investor, I might like the idea that I've mitigated some of the risk of my investment, because as an investor, when you put in money for a safe, that money's going to the company and you're along for the ride. There's no promise whatsoever that that safe will ultimately convert into equity of the company. And there's no guarantee whatsoever that you will ever have any return of that capital whatsoever. Whereas a convertible note is a debt instrument bearing interest, right? So as an investor, I might want a convertible note. And you might say, well, why aren't investors always clamoring? Like, why would you never not do a convertible note as an investor? This thing goes back to what the market is at this time and Y Combinator's kind of creation of the safe and the shift towards that, and really our early 2000s, you could say, and pre-pandemic banner years of, you know, these companies with crazy valuations really having a lot of leverage in negotiations with their investors. That shifted the market, right? Companies were able to say, I'm not going to issue you a note. I'm not going to take on a debt obligation and pay interest out. I have plenty of investors who want to give me money. You got to do a safe, or, you know, or we're not, you know, I'll find somebody else. I'm oversubscribed. So I think it really depends on which side you're looking at, company or investor, and what the market is willing to bear. Now that we've had a little post-pandemic slowdown, I have seen investors start to come back and ask for convertible notes, and companies being in a difficult situation where they are not oversubscribed. There are not people, you know, beating down their doors to literally give them money. And so I think the leverage has swung back to the investor a little bit, not all the way, but I am seeing convertible notes again more than I had, I would say, for the previous 4 to 5 years. But Jordan,
And
you
that,
know, it's a great question.
yeah,
I'd
no,
like love your take as well.
yeah, just to maybe add a last kind of perspective on it, you'll because the safe form is published online by Y Combinator, right? Anybody can use it. What I have found is that a lot of my clients, particularly the really early stage ones, take use the form and without telling us, right? So convertible notes, even though there are a couple different like types of forms that they could take, you more often need an attorney to kind of walk you through it. Whereas the safe is designed to avoid this, right? It's designed to kind of cut us out of this process. So that I think also contributes to why a lot more companies will use a safe and we won't even know about it, and we'll see more negotiated convertible instruments. It's just the instrument is intended to cut out some of the negotiating and transaction costs. Eventually, when you do that price to equity round, you're gonna all those people who invested will then turn into equity holders on the cap table.
And
So.
that's the double-edged sword we see. I think this safe has become so commonplace, and you can download it all, you know, from the internet for free, that we're seeing companies who have done huge safe rounds, let's call them, really early on. And then we get to a price round. And not that it throws a wrench into things, but I think the founders don't really realize how much of their company they have given away, because you can't at that point. That is the biggest downside to the safe. You as the company do not know how much of your company you are giving away to these investors. And you can really lose sight of that as people are just writing you checks, right? I got another $100,000 safe, another $100,000 safe. And all of a sudden I have a couple $1,000,000 of safe out there. Wait a minute, when they convert at the price round based on this raise I'm doing, all of a sudden that's 5, 10, 15, 20% of the company that I did not think, right, that I was giving away. And this lead investor in the price round is also expecting 20%, right? So back of the envelope math, wait a minute. I had initially owned 100%, or maybe I own 50% with an equal partner. We've all of a sudden found ourselves in a situation where we've done our first true raise, and we actually only own 60% of the company combined, right? And that is probably the danger to the safe, that people just, it's so easy to issue them and take the check in.
Right. So let's kind of use the time that we have to kind of show what this tangibly looks like on a cap table. Go ahead, Eli.
Absolutely. So, and I'll come back to this. We got another question about what's the most negative aspect of the safe? I would say it is, I'll just answer very briefly. It's what I just said, right? That I think companies can very quickly lose sight of what it is they might be giving away from an equity perspective because it's so easy to issue. You do not need a lawyer, right, to pull it from online, fill in your cap or pre or post money valuation, whatever type of safe you're issuing, and take in the money. And now all of a sudden you have funds to be able to pay folks to, just meet your working capital needs. And you can very quickly lose sight from a company perspective of how much equity that is ultimately going to translate into. Other than that, I don't
I'd say
think
one other
yeah.
thing that I see this is it, there is in the way that we legal practitioners have come to understand how to model out how a safe will affect the cap table, there is not necessarily uniform agreement among tax practitioners about how safes are taxed. And particularly where the entity is not a C corporation, but a pass through, right? So now you've got a partnership and you're trying to model out how people who hold this convertible instrument, whether or not they are partners in this partnership and whether to allocate income to them, because that's one of the aspects of flow through taxation. So there's just I've observed not uniformity among the tax position on it, and you'll see some tax positions say, "Oh, this is well understood." Even if it was well understood, it's not uniform agreement. So that can be a challenge for some early stage companies.
Yeah, and the last thing I will say, and then we'll get into this because I know everybody wants to focus on this part, is that when the safe converts, they're going to convert into the type of equity being issued in that priced round. So that lead investor in that priced round might be able to negotiate a lot of features of the preferred that you actually were not expecting to give to these folks who are only contributing 20, 25, even 50, or maybe even $100,000, right? But now they own preferred stock once they have converted, and they get all of the rights associated with that preferred. And you're just not even thinking about that because, again, the benefit is we don't have to think about any of those features now as we're issuing it. But could that come back, to bite us if in that negotiation to do that price round, we have an aggressive investor who is able to negotiate for a lot of preferred features that now we've given to all of our safe holders as well. Moving over to the cap table and then any other questions, feel free to continue to put questions in the chat and we'll hit them at the end of the presentation. What Jordan has up on the screen is kind of the most basic form of a cap table pre any third party investment, right? So what we're seeing going left to right is common stock and the total, your percentage of ownership of the company, and then percentage FD means on a fully diluted basis. So probably starting even with that, you're going to hear that term fully diluted a lot when you're talking about cap tables. And fully diluted takes into account not just shares that are actually issued and outstanding. It is not just the 10 million shares of common stock issued to the two founders. It's shares that are issued and outstanding, shares that are otherwise reserved for issuance, as you would do with an option pool or an equity plan, where you say, I'm going to set aside 500,000, 1 million shares to issue to service providers. That, even though they're not issued, that gets counted in this number. And then also, any items that were promised to folks as well. So very important distinction because I think a lot of folks think about capitalization as, oh, my two founders and I each have 50%. That's it. We own 50%. But on a fully diluted basis, to the extent that you've promised options, issued them, otherwise have this pool, that's going to bring down your percentage. And you will see that when we get to the next slide. But so here we have our founders holding common shares. We have some option holders. So in this hypothetical example, we have a chief technology officer who's in charge of the intellectual property of the company, and then we have a VP of sales, right? Presumably, you're going to need somebody trying to get whatever product it is, tangible or intangible, out to the market. And these folks have each been issued options to acquire common stock, right? And that's what an option is. You haven't actually been granted that share of common stock. You don't have the right to vote it. You don't get the benefit of the financial benefit of it until you've converted, but you hold an option to acquire it. And then those are our actual holders. And then below we have, just the option pool in general, the outstanding options, those 600,000 that we've actually given to folks, and the available pool are the amount of options that we could issue to other service providers, employees, or otherwise. And that gives us the total. And I think, Jordan, unless you have anything on this, I think we should go right to the next slide.
Yeah, the only thing I'll say is everybody who is an option holder, once they exercise their options and they pay that exercise price, they actually will move to they wouldn't be founders, but they would actually become fully, full holders of common stock. So you see some cap tables actually treat the common stock outstanding in one column and the options in another column because they want to make sure they understand who went from column A to column B, right? The key thing to understand, though, is if the source of somebody's common stock is the option plan, right? And the option plan has a defined amount of shares that are in it. Once somebody exercises, those shares don't go back into the option plan, right? Why? Because the agreement between the founders and the investors is that we are willing to dedicate this number of shares to the plan, and only this number of shares. So if somebody exercises, that comes out of the plan, you don't put it back in. Some people sometimes get a little bit confused on that.
No, and that's a helpful distinction. And that's also a very important point from a cap table management perspective. Defining the option pool allows you to do this future modeling for future rounds because, as Jordan noted, it's not going to go back in. It's not an ever expanding pool. You're going to work with a set number. So here we're taking a look at a cap table where we have received a preferred investment. And I think what is probably the most important thing for everybody to realize on this table, and I don't know if we can hover over it with a cursor, Jordan, is the percent of common stock, and then what happens on a fully diluted basis. And you can see what has now happened by the issuance of the preferred shares to our investors, by an increase to our option pool. Very often, your preferred investors will want you to set an option pool at a certain size to be able to make these issuances to folks to expand the company and to grow it. And very quickly, even in our initial preferred round, you can see how quickly our founder equity has been diluted, right? And I think, barring everything else on here, that is the key takeaway for you all as, potential or, current founders of your company. Jordan, I'm having a little bit of a tough time seeing on the right, so I don't know if you want to quickly touch
Yeah.
on that.
Yeah.
Bucket.
So here's the thing to understand is we've all talked about, dilution. This equation starts with what is the value of the company when I invest, right? We will hear that referred to as the pre-money valuation. Before my money goes into this company, we need to negotiate, me, the investor, and you, the founder, about what the value of the company is, right? And so we'll use that to determine how much the money that I do give you will dilute, right? So it's mathematical, right? It's if I'm going to give you, in this example, there's $1.6 million among these 4 or so investors, and the company is worth $10 million when I invest, then after I've invested my money, my $1.6 million represents 1.6 over $11.6 million, right? That's what I as an investor have gotten. And that pre-money valuation is going to be calculated on a per share basis on how many shares are outstanding before my money comes into the company, right? So that's what we would call that the pre-money fully diluted, as Eli was saying earlier, capitalization. If you count up every share of common stock, every option that was both the option pool, the issued, and the reserved ones, how many shares were actually included totally in the company before a dollar of my money came in the company. Now, the one thing that sometimes trips people up is when you are doing the pre-money capitalization, in some cases, the investor will want the option pool that's going to be created after they've invested their money to be counted in the pre-money capitalization. And the easiest way to understand this is, look, we agree we need to set aside some money, some pool of shares beyond what's already been allocated, right? To incentivize people over time. It's accretive. It benefits everybody to have a constant pool of service providers getting equity and upside in the company, right? But we agree it's got to be 10%, and I don't want to be diluted beyond this $1.6 million that I'm putting in, right? So I am negotiating for the options that are come out. They're going to come out after I've invested my money. I want those to count in the pre-money capitalization. That's so when they come out, they're not diluting me over time. So when immediately after the round, if the investor has negotiated to own maybe 10% of the company, they're actually going to own more, but on a fully diluted basis. As the shares in the equity comp pool come out, they're going to be slowly diluted along with everybody, right? So there's kind of circular math involved because you don't know how many shares are going to be that are going to be in the pool until you know how much cash is coming in. That's just something that you work with your attorneys and you kind of model it out in this way. Um, I think the last thing to demonstrate here is this shows the impact of convertibles. So in this example, we took the exact same investment round that Eli was just talking about, and we added safe holders, right? And this safe, for simplicity's purposes, is a discount only safe. It's just, the safe investors get a discount on what the new money investors get. So here's the bottom line, it further dilutes the pre-money price per share. So as a founder, if you didn't have safe holders in this prior round, your shares were worth 84 cents a share, right? Now it's worth less because you've previously gotten some money from these convertible investors, and that's going to increase the amount of the shares in the pre-money capitalization, which decreases the price per share. So it's marginal, but you see if in a prior round with no convertibles, there was 36% after the round is done, it goes down a little bit to 35%. Why? Because there's more people in the picture who are going to own shares.
And Jordan, this goes back to when we were talking about the difference between safes and convertibles, and safes sound great, but what can be a pitfall? Jordan is modeling just two safes, right, at $100,000 a piece. That's not a lot of money on a $10 million pre-money valuation converting via safes. I've seen it where it could be more like $1 million, right, in total safes outstanding. And so you could quickly see how just issuing one safe after another, doing multiple rounds, once you get to the price round, how big of an impact that can all of a sudden have on the founders, right? Because as Jordan noted, the preferred investor is not taking on the dilution of those safes, right? That is going to hit the founders. And so again, just being very mindful of how much you are raising through safes. Again, it's an incredibly valuable tool. It has really revolutionized fundraising for early stage companies, but it is not without I would say it's pitfalls and things to be aware of.
Yeah, so I think we're up on time, and we had reserved a couple of slides to talk about just kind of the life cycle and securities transactions. I think we can summarize them with the general kind of idea that, again, when you buy equity or when you issue equity, whether it's to yourself as a founder or a third party, you're engaging in a securities transactions. You're going to want to make sure that you have some type of exemption from the general rule that you got to register it with the SEC. You're not, out of the world of being subject to SEC rules, but you can have a way to do it without going through the expense of a long process. We've kind of overviewed here the different safe harbors, which are, if you follow these things, you can be safe to know that you are taking advantage of the private placement exemption, which is for companies raising capital in private transactions. A lot of rules, a lot of things to consider. This is something that you want to carefully just be aware of and know that you discuss with counsel. So I know we wanted to leave time for some questions, but that's the rest of this presentation.
And Jordan, we did get one, and bearing in mind, time, we got a question about suggested reading material. I'll give a quick answer, and then I think what we could do is, Ala, we can connect after the presentation. Jordan and I can kind of give some thought as to maybe a 5 to 10 kind of valuable resource sort of list that we might suggest for other folks. But because we mentioned them on the call, I think, Y Combinator's overview of its product, since at some point you all are going to be familiar with it, is a great start. They have instructions basically and an overview about what are safes, how they work, how their model documents work. So that's for the true early stage financing that some of you may either have gone through, be going through, or shortly be going through. And then that next stage of financing, right? Call it Series Seed, Series A. The National Venture Capital Association, so nvca.org, is an incredible resource, and they have a suite of model documents. You should become not only familiar with them, but read all of the available resources on that site, because I don't know, Jordan, 9 times out of 10, maybe even more, when an investor comes to you, approaches you as a company and says, I want to invest in your company, we're going to start from the NVCA documents. You will hear that all the time. So that's a preferred stock purchase agreement, investor rights agreement, voting agreement, right of first refusal and co-sale agreement. And there are some other ancillary documents that you might have, but that is a great resource, to think about that next stage when you're getting ready to do a price round, because invariably, again, there are always exceptions, you will be using those model documents as your financing documents.
Yeah. One more, if you indulge me, Al, one more reading material plug. Noah Wasserman wrote a great Harvard Business Review article called The Founder's Dilemma that later became a book. This is kind of required reading material because it answers not just the question of mechanically, how do you do these things, what are you issuing, but how to think about allocating equity among founders, technical founders, right? Business founders, and also those folks who are critical early employees or service providers, but not necessarily founders, right? So it'll kind of get, your kind of your thought process going about, okay, if I've got a pie, am I going to reserve 50% of the pie for myself? If somebody asks to partner with me and they are a technical founder and I'm not, and I have a software company, is it reasonable for them to ask for 30 to 50%? Maybe yes, right? So the Noah Wasserman's, at least start with the HBR article, will help you answer some of those questions for yourself.
So I'll post those links in the chat for folks who are interested in navigating to those sites, getting the book. And as we discussed, Jordan and I will give some thought, and I'll hopefully maybe you can disseminate something after the presentation. We'll come up with a kind of a short list of some good resources for folks.
Yeah, thank you so much. This is, of course, a topic that is really hard to cover in just 1 hour. You can. It's a lot. So thank you so much for cramming so much information. Just wanted to let everybody know too that Eli and Jordan will be leading another session for us on Thursday about the various documents and agreements that each of startup needs. This is the kind of the topic that most people don't realize when they start companies, that you need agreements prepared. When a customer knocks on your door, what are you going to do? You need to have agreements that they will sign. How do you do that? So it's an interesting, very important topic applicable to company in any industry. And so please tune in on Thursday at 1 o'clock to learn about that. Also, Eli and Jordan kindly provided the slides, and I can circulate them to everybody. And thank you to everyone who stayed until the end and even over time. And thank you, Eli and Jordan, for giving us extra time as well.
Absolutely. Thank you all. Thank you, everybody, for joining us. And we hope to see some of you on Thursday at 1 o'clock.
Yes, thank you so much. Have a good day.
Thanks, everyone.